Welcome, everyone. I'm delighted to have my good friend Con Hurley as guest of Economics Matters, the podcast. I thought it would be that it's important for us to do an update on the financial crisis, the banking crisis that is here again, now again, here again, on and off. And today it seems to be back a bit. But I thought it was important enough to grab Con, who's really an expert on these matters, to talk to, even though he's only like 2 days out from having a hip replacement. So I said, that's no excuse. He's on drugs, he tells
Yeah.
me. So we're not
Uh,
supposed to take anything too literally, he says. But even Con on drugs is a lot better than anybody on this topic who's sober. So let me.
well, you just committed two HIPAA violations. No pun intended there, Larry. So you'll be forgiven for that.
Okay, thank you. Sorry. um, but anyway, I'm glad you're doing well,
Thank you.
and thank you so much for joining us under these circumstances. So let me just tell everybody about Khan's background. Professor uh, Cornelius K. Hurley has over 30 years of diversified legal and entrepreneurial management experience in financial services. He is a director of a computer share trust company. Uh, he's a former director of the Federal Home Loan Bank of Boston. Uh, Khan has established the Boston office of the Secura Group in which is located in Washington, D.C. He formerly was General Counsel of Chalmette Corporation and Assistant General Counsel of the Board of Governors of the Federal Reserve System. So that's the mothership. General Counsel, Assistant General Counsel of the Federal Reserve is a big deal, and so you don't get to that position easily. Khan's very active in the American Bar Association. He's a faculty member of Banking Law Basics, Banking Law 2, Consumer Financial Services Basics, and Investment Management Basics, all institutes conducted jointly by the Marin Center and the American Bar Association. I don't know if are you teaching your banking structure and regulation
Yes.
course, or you
Yes. Yeah. We call it financial crisis to fintech now. Everything has
okay,
to be modernized
and that's you're teaching that at BU, or
at
if
BU. Yeah.
it's still PD. Okay. Uh, Khan also serves as a reporter of the American Bar Association's Task Force on Financial Markets Regulatory Reform. Uh, he has run many a very interesting seminar and conference at BU with major leaders in the financial arena, regulators and people in the actual industry. He's brought them together to discuss financial regulation. So he's a real expert. And just today I was talking to Com earlier today to prepare for this webinar, this podcast. And as I pulled up the, I guess CNN just to see what was going on, learned that S&P Standards and Poor's had just downgraded five banks, five mid-sized banks, just literally 2 minutes before we hopped on the phone to talk. Let me stop here, Con, and ask you to give us a kind of your background, how you where you were born and how you went from where you were born to your entire career, ending up being, basically at such a high level in the Federal Reserve. Go ahead.
Well, thank you, Larry. My apologies to your audience for having to sit through all of that. Well, I was born as a very small child, and where I got into financial services has a lot to do with lemon meringue pie, actually. When I was a law student at Georgetown Law School in Washington back in 1974, I guess it was, I had friends that worked at the Federal Reserve. And the Federal Reserve, as you know, is independent. It's not a appropriations agency. It runs itself, probably returns to the government every year hundreds of billions of dollars. Anyway, it had a wonderful cafeteria as a result, and they had outstanding lemon meringue pie. So I used to make a point of going there every Friday afternoon that I could to visit with my friends. And one afternoon, when I was over there for friends and lemon meringue pie, my friend told me that they were interviewing for positions in the legal division. And I interviewed and I got the job, and here I am today. So that's.
Now, what year were you? What year were you having the lemon meringue pie at the Fed?
Pardon me, where was it?
What year was that?
That was 1974. Yeah.
Okay, I was having lemon meringue pie there like 2 years later. I was an intern.
Oh, okay.
Intern in grad
All
school.
right. Well, those were in the very much simpler days, but before the Fed owned the world as they do today. And the Fed complex, the buildings, and so growth has just been enormous since then, as reflected in the Fed's balance sheet.
And the ownership of the world is, it's also kind of this financial connection and support that the Fed has been providing to global banks, private banks, as well as central banks. So it really kind of owns or kind of controls the financial system globally.
Yeah.
I recall that the first check that occurred under the TARP bailout was sent to a French bank to pay off to help them pay off a loan that they owed to Goldman Sachs.
Sure.
So the French bank would not go under.
Oh.
So let's talk about what's going on. Maybe you want to kind of summarize your view of what's been going on since March. You said 13th is when Silicon Valley Bank.
Yeah, my recollection is that Silicon Valley went first. Actually, if you want to back up a little bit, kind of the sequence of freaky events that led to ultimately the demise of Credit Suisse. You have to recall that a GSIB went down in this process, which is amazing. But there was a small bank in California named Silvergate Bank, and it was a crypto-only bank. And it ran into trouble in late 22, and news of its being in troubled condition. It was very small. It wouldn't, in normal circumstances, it wouldn't have attracted much attention at all. But for the fact that it was revealed at almost the 11th hour that it was being propped up by the Federal Home Loan Bank of San Francisco, which is a giant $1.6 trillion enterprise that we can talk about later in greater detail. But it was that whole system of home loan banks was created to stimulate and support housing back in the 1930s. But here it was in the 2022 stimulating and supporting crypto banking. And when that was revealed, it was a shock to many people because, my God, how could this system created for home loans have gone so off the rails? It was supporting crypto. And then, of course, the bank failed just a few weeks later. So that was in, I think, either late February or early March. Along comes Silicon Valley Bank, and people were already a little bit nervous about the banks in general, and it decided, because it was in some trouble, it had a run on deposits, and its assets were largely in government securities. it figured that, okay, we'll just liquidate some of those securities. We'll raise a modest amount of capital, and we'll be okay. Well, they did liquidate some securities, but they were unable to raise any additional capital because at that moment in time, the market was spooked largely by this Silvergate bank that had just gone down. So they were then in deep trouble. And then when that word got out.
Let me just interject for people that aren't, expert in this lingo, that raising capital means selling shares of stock to bring in extra money that you can then invest.
That's right.
And potentially, have as kind of, or putting in cash, just have as in cash to pay out depositors if they try and take off, because you have to pay on deposit, so you don't want to go under, not be able to.
That's right. Capital serves as the buffer between you, depositors, and other creditors, and failure, right? So they were unable to raise capital, and then other depositors freaked out. And I think it was within 36 or 48 hours, $42 billion on a $200 billion bank exited. And I think the remarkable thing about that was, and this is I can't wait to read the histories of this as they're written in years to come. Maybe Larry will write them, but we think of bank runs in terms of George Bailey's savings and loan, and people jammed up in the lobby wanting to get their money out. This was that, but on steroids. It was people not in the lobby, but people withdrawing their funds online and doing it in a nanosecond. It was, and they were sending it to all kinds of other places. Two in particular. One was money market mutual funds, particularly government money market mutual funds, and Larry can tell you more about those. But also to the banks that are considered too big to fail, those what are commonly referred to as GSIBs, substantially, I forget, government
systemically
important banks, government systemically important. Thanks, Larry. So, and that just happened like virtually overnight. And then it was revealed that bank, the Silicon Valley Bank itself, owed $15 billion to the same Federal Home Loan Bank of San Francisco, right? Because it had used it as a funding source for depositors when they were withdrawing, until that ran out of supply.
So they were borrowing from the federal bank borrowing from the Federal Home Loans Bank to make money, to pay money going out the door. Yeah.
Yes. Right. Yes. Right. Exactly. That was the first line of defense when the depositors started to flee. Was they borrowed from their home loan bank, and we can get into the mechanics of that if you wish. So naturally, when there's a crisis like this in one bank, people look over the parapet and they say, geez, what other banks are out there that look similar to that? Well, there was a bank in New York that named Signature Bank. Footnote, one of the directors of Signature Bank was a gentleman by the name of Barney Frank. You may have heard of him from Dodd-Frank fame. Anyway, Signature Bank.
And by the way, let me just interject. So when we had the last financial crisis, the great financial crisis of part of the Great Recession, Barney Frank was the head of the Financial Services Committee of the House. Yeah. And Chris Dodd was the head of the Senate Banking Committee?
Banking and Housing Committee in the Senate, yeah.
So the two of them put together a piece of legislation called the Dodd-Frank bill that was supposed to make sure that this never happened again, that we never had another financial crisis. And the reason we're having this podcast is because I suspect, and I think Con agrees, that this could be the beginning of another great financial crisis, or at least, very similar to what we saw in the S&L crisis, which was a huge financial crisis that took place over 9 years. Actually, didn't take place over 18 months or so, as the great financial crisis did, but was a huge banking crisis. And we're really discussing today the background to what may be another great financial crisis that could bring down the economy, just like what happened in the Great Recession. But fire away here. Keep going. This is fascinating.
So Silicon Valley Bank fails, and I think that's like on a Thursday or a Friday. But there's this other bank in New York, Signature Bank, which is also a crypto bank, not exclusively a crypto bank like the aforementioned Silvergate Bank was, but it's definitely cast its lot in the crypto industry. So it was also in the sphere of suspicion. It also turns out had, I think the number is about 10 billion in advances from its home loan bank, Federal Home Loan Bank in New York. And it had a portfolio of assets that very much mirrored Silicon Valley's, and its depositors freaked out and began to withdraw money, and it was not able to raise funds immediately. So on a Sunday, I think that was March 12th, that bank was closed. So here you had two banks closed, large banks, two of the largest banks that had ever been handled by the FDIC. I think the only larger ones were Washington Mutual and Countrywide Bank, maybe IndyBank. No, that IndyBank wasn't as big back in the previous financial crisis. So everybody's freaking out.
So this is happening even though they had Barney Frank, who had set up all these regulations, and then he goes and cashes out of being, being the regulator of banks in the Congress, really the chief regulator in the House of Representatives, to selling out and becoming, in my language, selling out and taking money as a director of this bank that obviously was being run in a way that was highly risky and was not going to be saved because of Dodd-Frank. So
let's file that one under the irony file, I guess. Have it there. But what is
file,
what the interesting thing in all of this is that you have to keep your eye on a line item on bank's balance sheet called uninsured depositors and uninsured deposits. You have insured deposits, which are covered up to $250,000, largely retail, and those are safe, they're stable, and whatnot. But the uninsured deposits, particularly like Silicon Valley had, can flee in an instant. They are highly liquid, and previously regulators and bankers viewed them as an indication of stability. Now, with the learning from Silicon Valley and Signature Bank, we realize that these uninsured deposits are, in fact, a marker of instability. And you may recall that during those dark days in March of this year, not that long ago, the Treasury Department and the FDIC and Fed all got together and they declared summarily that all of the uninsured depositors at Silicon Valley Bank and Signature Bank would be covered. But only the uninsured depositors at those banks. Well, you're talking about scores of billions of dollars of liabilities that are all with the stroke of a pen covered by the federal government in an instant, right? Leaving the entire rest of the banking industry exposed. So the question at that time, and the question still unresolved, I think, for our system is, what is the status of that guarantee? Hold that question for just a minute, and we'll get to the next leg of the stool, which is First Republic Bank. So we get through the.
Let me just interject a factoid here, which is that at the time SVB went down, there was $18 trillion of deposits in federal deposit insured insurance corporation banks, banks that were where the deposits up to a certain level, 250,000, were insured by the FDIC.
Right.
And we had, of the $18 trillion of deposits, only 10 trillion were insured. The other 8 trillion were uninsured. And so what happened here is that the Fed, the FDIC, and the Treasury decide to insure just the uninsured deposits of these two banks that failed, Signature and SVB, telling in effect the rest of the uninsured, the rest of the uninsured depositors who had money in all the other banks in the country, that maybe you wouldn't be insured if your bank had a, and in effect they were inviting the other bank, if I've got more than 250,000 in some middle-sized bank, and the Treasury Secretary is saying, well, we're not sure you're not systemically important, we may not come in to bail you out, that makes one very nervous to keep their money.
Larry's exactly right. So repeat again for me, Larry, at this moment in time, say March of 2023, what the amount of insured deposits is.
So it's insured is 10 trillion, uninsured at the beginning of all this was 8 trillion, so 18 total.
Okay.
And then
so
1 trillion in the next month, 1 trillion leaves. I don't know how much is still there.
So just in round numbers, let's write that $10 trillion number down. Okay. Now I'm going to tell you the balance in the Federal Deposit Insurance Corporation Fund, the Deposit Insurance Fund of the FDIC, to cover that $10 trillion. It is approximately $28 billion.
28 billion.
So you have $28 billion propping up $10 trillion. And you can see that this promise that was communicated to the world by Treasury, the Fed, and the FDIC was really a promise that if things grow really lousy here, we, the Fed, are willing to lend the FDIC the difference between $10 trillion and $28 billion on you, the taxpayers, dime. Yeah.
But yeah, and just to add to this story, this scenario, if you had, they start with there's 8 trillion of uninsured deposits. Within about a month or so, a trillion leave. There's still, I just checked, about 7 trillion of uninsured deposits still left in the banking system. If they all left tomorrow or today by typing in a nanosecond, as we're having this conversation, if everybody's listening in, these bankers, they were all to pull out, then, a huge, probably at least half of the banking system would fail. Probably, 3,000 of the 4,200 deposit insured banks would just go under, or maybe more. Complete banking failure, and the only way that could be, and then all these insured depositors, where they're asking for the $10 trillion, they turn to the FDIC. The FDIC has $28 billion left, and consequently, the Fed would have to print something like $10 trillion. Now, that would cause everybody to expect hyperinflation, which means then everybody would want to run and get their money out in order to go buy some furniture from IKEA before prices went crazy. So
Yeah.
you see, we have basically a promise deposit insurance, which is not really for real because
Hmm.
they're trying to insure an aggregate risk. Insurance companies, as a group, can insure what we call idiosyncratic risk. Your house burns down, his doesn't. The insurance company breaks even. But when you're trying to insure a macro risk, that's a gamble because you're promising to making a promise you can't keep under certain circumstances, and we're now talking about a promise that can't be kept. So, as this is all happening, there's the potential here for the economy to flip, and everybody, because something else occurs, and maybe it's today's announcement by the S&P that they've decided to downgrade, and then Moody 2 weeks ago decided to downgrade, I think, 10 banks, Moody's, and to tell everybody that there are 5 major banks, including Northern Trust, State Street Corporation. These are huge banks. Bank of New York, Mellon Corporation, a big bank where we live in the New England area is Citizens. They were just part of the S&P, I believe. I think they were part of the S&P down. Well, anyways,
Yes.
no, they're part of the Moody's, shifting the outlook of 11 banks from stable to negative. So Moody's and S&P have just put thumbs down on about 15 sizable banks, and then Moody's just said that they're putting under review 6 major banks, including State Street, Northern Trust, Bank of New England, New York Mellon Corporation, which is one of the oldest banks in the country, U.S. Bancorp. So it's kind of trouble here in River City, I would say.
Yeah. Yeah. So the government made in the Silicon Valley instance, Signature Bank, they made wild promises to guarantee uninsured depositors, which they did it to to settle the markets at the time, which were roiling. And as Larry points out, the promises are fine unless you cannot keep them. and on a macro level, it would be very difficult to keep them. But hey, up until this moment in our economic history, the Fed has been able to keep those promises that it had made, whether it was the Silicon Valley promises or the promises at the time that Bear Stearns failed and AIG and all the rest. Anyways, to return to the narrative, after these 2 banks failed, and by the way, eventually Silicon Valley Bank was taken over by First Citizens Bank in North Carolina, a much smaller bank, and it had made a career of buying banks out of the FDIC. The FDIC will probably end up losing 25 to $30 billion on the Silicon Valley receivership. Mind you, the balance of the deposit insurance fund is only $28 billion. So there's a lot of catch up that has to go on with the banking industry, because it's the banking industry through premiums on its deposits that funds the deposit insurance fund. And Signature Bank was taken over by Flagstar Bank, previous known as Community Bank in New York, and I don't know. I think the losses to the DIF, Deposit Insurance Fund, are in the neighborhood of $10 billion there eventually. But in this moment in time, March of 2023, people again are looking over the parapets and saying, hey, what banks out there look like these? And the next one out there that looked like them was First Republic. Bank, which is a $200 billion bank located in California, but with offices in Boston, the Boston area, and New York and Florida and the West Coast, but largely on the coast. It catered to wealthy individuals, whereas Silicon Valley catered largely to startups and venture capital firms and their clients. And for a perilous several weeks there, First Republic was dangling out there, trying to unload its assets, trying to raise capital, which it could not, and eventually it was put into receivership by the California banking authorities and taken over by J.P. Morgan Chase, which created its own controversy because J.P. Morgan Chase, as we all know, is one of the GSIBs, the too big to fail banks. And people were scratching their heads and saying, hey, why are you allowing one of the already too big to fail banks take over a large regional bank? That's no solution to the problem. But from an FDIC standpoint, which is under a statutory mandate, to achieve the least cost resolution, that is the least cost to the deposit insurance fund, they made the judgment that the J.P. Morgan Chase bid was the better of those. So, and then you had other banks, Pacific West, Western Alliance, others, maybe some of the ones that were on Larry's list. Oh, and by the way, I have to mention again, Republic Bank, First Republic Bank, when it failed, had $28 billion that it owed to, guess who? The Federal Home Loan Bank of San Francisco. You begin to see a trend here, and this benign little government agency that people thought was just a liquidity facility for banks to help them make mortgage loans ends up being a very pernicious lender of second and last resort to troubled banks.
And they're getting their money they're borrowing money from the Treasury. I mean,
they borrow their money largely from in the open market. It's money market mutual funds are the largest purchaser of their debt, but because they're a government-sponsored enterprise, they borrow at costs that are just 1 or 2 basis points above what the Treasury borrows at, right?
So this is now turning into like Fannie Mae and Freddie Mac that were nationalized right before Lehman failed in August of 2015.
Yeah.
Right? This is looking very similar, right?
It's very, very similar. You'd have to be blind not to see the similarities going on here. And so now we have other banks, like you mentioned a bank in our region, Citizens Bank, but Webster Bank. Nope. Unless you heard of Webster Bank or in a community that has one of its branches, it's a smallish bank, maybe 50 billion, 70 billion in assets. It is borrowing $10 billion from its Federal Home Loan Bank. And people are asking, myself included, over the last year or two, when a bank needs to raise money, it raises deposit rates, right? Or it sells CDs. You think of that as the way a bank would raise money. But when a bank has available to it a federally subsidized government facility like a home loan bank, and it can go into the market and raise subsidized funds subsidized by you and I as potential depositors at a cheaper rate, it's not going to raise its deposit rates. It's going to keep its deposit rates very, very low, as they do. Only now as the reverberations of Silicon and Signature and First Republic Bank are being felt in the marketplace, are banks truly starting to raise their deposit rates. But I have to add the big caveat to that is that the deposits that have been sucked out of the banking industry to the tune of $1 trillion or more have gone to two places. Number one is the GSIBs, the too big to fail banks, the JP Morgan Chases of the world, Wells Fargo, Citi, et cetera, Bank of America, those. The other half has gone to the money market mutual funds. All right.
Mhm.
What have the money market mutual funds done? They've invested in the debt of the home loan banks. And what have the home loan banks done? They've loaned money to the banks. So we have this circulatory system here that is going on where one of the pieces of the plumbing, namely the home loan bank, doesn't make any sense. You know, it is a competitor to the discount window of the Federal Reserve, the lender of last resort. And people are beginning to ask themselves, do we really need two lenders of last resort? And the answer to that is obviously no, we don't.
Right, because they're putting, they're borrowing from the public with this basic guarantee from the taxpayer. So they're putting all this potential liability onto the public. So the money, the uninsured depositors is leaving to, let's say, money market fund, and because it wasn't insured, and then it's going back in, and it's being, in effect, the taxpayer is now taking over the insurance of, taking over the responsibility of insuring these banks that are kind of underwater indirectly. So
that's exactly right. I'll just give you another part of the home loan bank story that will drive your audience crazy. The home loan banks, there are 11 of them throughout the country. Full disclosure, I used to be a director of one of the home loan banks. I was for 14 years. And you can tell they're probably not too happy with me right now. But these 11 banks issue loans. They call them advances. And the big brag about the home loan banks is we never made a loan that went bad. In 90 years of lending to banks and others, they never made a loan that went bad. And that's pretty impressive, right? On its face. But here's the tell. In the case of every loan that they made that went bad, which is Silvergate, Silicon, Signature, First Republic, going back forever, it's the FDIC that pays the bill. It's not the home loan bank. So they can say with some credibility that they never lost a dollar on a loan, but it's a half-truth at best, because the taxpayer, via the deposit insurance fund and the open-end line of credit that you and I have to the Deposit Insurance Corporation, ends up paying the bill for their bad loans. So you have a circumstance where the president of the Federal Home Loan Bank of San Francisco, whose bank made all of these terrible loans, not the New York loans at Signature, but the three others, made all of these loans, $50 billion in bad loans, would have sunk any other bank, right? But because of the FDIC picking up the damage after they had made the loan, they were not in trouble. The CEO, was fired 2 weeks ago. She was forced to take early retirement, put it that way. That hasn't hit the news. That's public information. It was reported by one trade association. That should have been front page of the business section news. Let
me ask you, you think that was who forced her to be, who fired her? Do you think it was the board that said,
well,
or what do you think, it's the Treasury Secretary in effect, or where's this coming from?
That's an excellent question, and had they published the fact of her retiring, people would have been asking that question. I think personally, I think it was the regulator that forced the hand of the board, and just as a former regulator myself, I know that that's how those things usually go down.
Would this be a regulator inside the Treasury or inside the?
The home loan banks are regulated by the same regulator as Fannie and Freddie, which are in conservatorship. It's called the Federal Housing Finance Agency, and it's one of those rare agencies that's headed by one person, just like the Consumer Financial Protection Bureau is headed by one person. So I'm going to guess that. And this is guessing on my part, but it's educated guessing that they were forced to make this change.
So Con, let's talk for a few more minutes before we bring this to a close about where you see things going, and the FDIC is running out of money, so they're soon going to be having to borrow from the Fed to. If this continues, more failures, and it sounds like the home loan banks are going to have to, those presidents are going to see the writing on the wall and say, forget it, we're not going to do any more of this. And call their current loans. They could do that, right? There could be loans outstanding they could be calling.
They could conceivably,
not reissue. So how likely do you see things melting down here?
Well, I'm not sure they are melting down so much now, because the government has taken certain actions. So, for example, two things. The regulators have proposed a significant change to the capital structure of not just the GSIBs, but all the banks. Which will increase the cushion that they have in the event of failure, and that's, I think, helpful. They've also increased the liquidity requirements. They're making a lot of technical changes in the examination and supervision process as a result of there was a massive regulatory failure here too. We can't fail mentioning that. That's number one, the capital requirements. Number two is the FDIC is raising the premiums on all deposits, primarily the deposits at larger banks. So over time, that will refurbish the Federal Deposit Insurance Fund. And this is worth watching too, a month from today, or sometime within the month of September, the Federal Housing Finance Agency, the regulator of the 11 home loan banks, is coming out with a very significant report that she's been working on for a year. And I have to take modestly some credit for her launching that review, because she said that it was my letter to her that prompted her to do it. And she will be announcing a comprehensive review in two parts. One is those changes that she can make by regulation, and then those changes that require federal legislation. And I've submitted extensive comments to her on that. I think for one thing that she could do by regulation tomorrow, should she choose, her name is Sandra Thompson, by the way, is if I've chronicled these massive amounts of loans to these banks that failed. The marketplace really didn't know in real time that the federal home loan banks were lending this amount of money to those banks. had there been transparency at that time, and I'm talking a year and a half ago, there would have been time for regulators, competitors, capital sources, all of these things to be aligned so that those banks did not fail. So what I've suggested to her is that just disclose those banks that are massively I've mentioned Webster Bank. Santander Bank in the New England area is borrowing massively from its home loan bank. Just disclose it and let the markets and the public ask the question, why are you borrowing so much from the home loan bank? Why aren't you paying more to me as a depositor? why are you paying the home loan bank?
Right. Now, if the government took that, if the regulators took that position with respect to disclosure, they would have to disclose that over half of the FDIC banks are underwater, bankrupt, if you mark them to market as of today. Because if you go back right after Silicon Valley Bank failed, which was, by the way, those three banks that you mentioned, Northern, was it were the three big one,
that failed? Silicon Valley, Signature, and First Republic.
First Republic. Those were the second, third, and fourth largest failures of time in the U.S. in terms
of isn't it?
Dollars. Yeah. So these are big events. And at the time, four finance professors got together and did a forensic study of the value of the assets and the liabilities of the 4,200 FDIC insured banks in the country. Right now, and then they reported that 2,300 out of the 4,200 were on a mark-to-market basis bankrupt. Now, since then, and this is largely as a result of these banks investing a lot of deposits in safe 10-year or so treasuries at low interest rates, and then interest rates went up and the value of those assets went down. So the liabilities, their value didn't go down, the assets went down. So that's where they end up going effectively mark-to-market bankrupt. But then if you ask, well, has anything changed since last March to make the value of those assets go back? Because the government is now letting these banks book these assets at book rather than at market. That's the original problem with SVB, that nobody realized that they had assets which they were valuing here, but they were actually down here in terms of their market value. Has anything happened to make those the market values go back up? Actually, it's the reverse, because the 10-year Treasury interest rate has actually gone up since these banks since March. The current 10-year Treasury rate is actually higher than back in March. Let me just give you those. It's a somewhat higher rate. I don't have the exact number, but let me just close this out here on a couple other things that are worrisome with respect to the banks, which is the commercial, the value of commercial real estate. We've seen, first of all, in general, the value of bank stocks. There's a KBW index. It was about I think 135 a year ago. Now it's 80. There's a commercial index fund, Vanguard, which I think is commercial real estate, like office. Large part office properties has gone down from 97 was the index value a year ago. It's now 80, the Treasury, the 10-year Treasury rate. Now I see the number here. It's now 4.3%. It was 3.7% last March when SVB failed. So these banks on a mark-to-market basis are actually in worse shape, if not much worse shape, because going from 3.7% up to 4.3%. When you're now discounting at this higher rate, and compound interest comes into play here, their market values are even lower. So how do you see? Are you worried about a complete meltdown happening?
Yeah, well, I worry about everything. Forget this program, but I think that precipitous decline in the KBW index from 135 to 80. I think that bakes in a lot of the losses in the CRE portfolio. I can't say for sure, but I do worry because we still have this unanswered question created by Treasury back in March when they threw a safety net under all uninsured depositors of just those two banks, Silicon and Signature, but not everybody else. Where did that go? They claimed at the time, that Silicon Valley was systemically important. That's a Dodd-Frank vestige that they triggered. And yet most market participants did not believe the Treasury when it said that they were systemically important. And when it came to First Republic just weeks later, clearly they were not systemically important, even though they were larger, and you could argue more important. So there was I think there was a vulnerability opened up there as to how the federal regulators handled the crisis at that moment. And that gap, the vulnerability has not been answered yet. We still have this large amount of uninsured depositors out there that time has told us can flee in an instant. And they can go to money market funds, and they can go to too big to fail banks.
Right. And First Republic, when they failed, were the uninsured depositors not protected? I don't recall any stories about these uninsured depositors.
No, they were bought out of receivership by J.P. Morgan Chase.
Oh, so they were in effect rescued that way.
Right.
They were
you may recall, for those that are following real closely, it was, as an interim basis, there was a consortium of banks that got together and deposited into First Republic. I think it was $20 billion to keep them afloat temporarily. But in the end, it was J.P. Morgan Chase that wound up absorbing the entire franchise.
Right. And then we should also not, end this without referencing Credit Suisse, which is kind of analogous right now to Citigroup, which is like, all these large banks, these systemically important banks, all have large uninsured deposits, including large deposits from abroad, just like just like Credit Suisse did. And when Credit Suisse started going under, I guess it was right after SVB, the Central Bank of Switzerland basically made a $50 billion loan to Credit Suisse, and that was not enough to keep the money from leaving. And then they had, in the end, United Bank of Switzerland, UBS, the government of Switzerland, they organized the largest bank to buy up the second largest bank and to calm things down. But there's nothing that says that UBS can't face a run from its largely international depositors. And when you think about it, if I'm let's say a Saudi billionaire that has money in credit in UBS now, and I've just seen my money from Credit Suisse, I left it there and it's now in UBS, but I just saw Credit Suisse go down. One, I get worried that UBS will go down, and if other people like me, if enough of us start worrying, will the taxpayer of Switzerland be willing to bail out billionaires from outside of Switzerland? I don't think so. So we have this potential for the way this banking system is structured,
Yeah.
because it's so debt finance, it's built on debt, on promises that can't be kept. We have the potential here for a run on UBS, on Citigroup, on JP Morgan, because as you say, the FDIC is about to go negative in terms of its balances. It's got 28 billion against basically $17 trillion of obligations. If they were to try and insure the uninsured deposits as well as the insured deposits.
Yeah.
So yeah, and let me just ask you one last thing, which is, you and I started talking about this at BU back in 2008 in the great financial crisis we had. I think we put on a conference together.
Yes, right.
And, I've been pushing for limited purpose banking, which basically makes the entire financial system a mutual fund system where there's no debt in the banks. They're just running mutual funds where they take in money by selling shares, and then they invest it in whatever they're investing in. But if those investments turn south, the shareholders take it in the neck rather than the taxpayer. But the financial middlemen cannot go under because they have no liabilities, they have no debts whatsoever. So they cannot literally go bankrupt by definition. And you never have the financial middlemen, the financial system collapsing, which of course is connecting lenders and borrowers and savers and investors. We need that highway system, financial highway system, to operate, to keep the economy operating. So are you coming around to this view that we should be moving to limited purpose banking? I think it's happening endogenously as it is. As you said, that money's moving to mutual funds or money market funds or mutual funds.
Yeah.
What's your view on this?
Larry, you very modestly failed to mention the brilliant book that you wrote on this subject. Jimmy Stewart is Dead. Is that right? I assume that's still available on Amazon, right?
Very inexpensive, yes.
Very inexpensive, yeah. For your audience, Larry did not put me up to that promo.
Thank you.
But I'm not quite there yet, Larry. You can keep working on it, and I think if I have a few more surgeries, I might be weakened enough. But here's the thing: I think we lose sight of the value that banks of all stripes are supposed to play. They don't always play it, but they're supposed to play that, and that is the role of credit allocator. Banks are supposed to be a third-party, independent, discrete allocator of credit, and that credit is the combined deposits that are placed with those banks. And having worked in a bank many years myself, I know that a large part of the bank apparatus is focused on that. Do you give a loan to a crypto firm? Or do you give a loan to a farmer? Do you give a loan to a bookstore, or do you give a loan to a fossil fuel operation? And that opens the door to the ESG argument. But I don't mean to do that. But I think the vulnerability of your approach, and I'm warming to it a little bit, is that who is going to play that credit allocation role going forward, if not the banks? And I think that's an important question to answer.
So just my quick answer would be that the George Bailey from It's a Wonderful Life, the movie, which everybody sees in Christmas because they play it. It's you can probably watch it on YouTube. He's the small town banker that everybody trusts, and he's making the right decisions about how to allocate them. But the movie starts out with a rumor that that Bailey saving a loan is underwater, and it's and everybody runs to the bank. And because George Bailey is Jimmy Stewart, and Jimmy Stewart's a great actor, and Jimmy Stewart can give a great convincing speech. He gets everybody to leave their money in there and actually even put more money with him. And that's great if we have George Bailey's, if we had Jimmy Stewart's real honest people, or if rumors couldn't lead to panic, but under what I'm proposing, the George Baileys would be working inside the mutual funds. They would be running they would be the money managers of a fund that's investing in mortgages in Boston or mortgages in Detroit. These would be closed-end mutual funds that would be fully disclosed by a federal agency in real time, so that there'd be a very good secondary market in their shares. So I think I understand. I hear what you're saying. We need to have that kind of personal, the personal supervision of where the money is allocated. But I think that would happen because you'd want to be investing in a closed-end mutual fund that had a reputation for doing well, and that would be where that role would be played. But anyway, thank you so much. This has really been incredibly insightful for me, and certainly for the audience here, because you've brought all kinds of information to this discussion that people would not otherwise know. I mean, I've talked to a lot of people about this potential financial crisis, what's going on. They haven't had this kind of inside information that you've brought to the.
Well, thank you, Larry. Thank you.
Thanks so much.
Yeah.
And
thank you for having me. Let's do it again.
Okay, we'll be all out playing pickleball soon, I'm sure.
Okay.
Thanks, Con.
Thank you to your audience. Bye-bye.